Inflation is here and it's getting ugly. Rates are at their highest levels in decades. There are pandemic-related labor shortages, material shortages, shipping backlogs, money supply concerns, and a lot more. Today we are talking prospects for investors, including the best and most profitable plays to inflation-proof your portfolio. Hello, I'm Susan McGinnis. Welcome to TheStreet's How to Play the Inflation Trade. We have an all-star panel of experts well equipped to advise us on inflation-protecting investments and investments that benefit from an inflationary environment. David Schassler, portfolio manager at the Inflation Allocation ETF, symbol RAAX at VanEck. Nancy Davis, founder and CIO at Quadratic Capital Management, and our own Bob Lang, Action Alerts Plus portfolio co-manager. Thanks all of you for being here. It's going to be an exciting discussion. Let's get right to it. The economy right now is in an unprecedented situation. We have these supply bottlenecks, we have unprecedented demand, consumers spending their stimulus checks, and all of this supply bottlenecks happening at the same time. Nancy, start us off. How long do you see this environment lasting?
I know that is the very popular question, whether this is transitory or not. I don't think it matters. I think at the end of the day, investors have to be thinking about how to have a diversified portfolio. And inflation protection is one of those things that you shouldn't be making a bet about whether it's going to happen or not, how long it's going to stick around, because at the end of the day, we live in a real world and we do have cost of living, we do have real expenses. And so I think whether it's going to stick around long term or whether it's transitory is not relevant. And all investors should just be thinking about inflation in their portfolio as a core holding.
Bob, do you agree we shouldn't worry about that part of inflation, but just whether we're protected or not?
I agree with that. And we can see it in the numbers. The last couple of months, the CPI has exploded higher, and consumer prices are reflecting a lot of the problems that we were having with the supply chain and getting with strong demand and with lower supplies. That is an economic equivalent of higher prices down the road. So for the past 4 or 5 months, we've seen 5+ % gains in consumer prices across the board. Energy prices have been soaring. We saw big price increases in vehicles, used and new, and other things as well too. Food and energy prices are just under enormous pressure right now. It's almost really that is almost unsustainable for the consumer right now. It's amazing that they've been able to hang in there. But this is a really scary situation, and I think I agree with Nancy that we really have to be paying more attention to our portfolios.
Mm-hmm. And some say the situation is only going to get worse. David, what would you say are the most important drivers this time around? You've looked historically at other periods of inflation. What's changed?
I think that this period of inflation is similar to other periods of high inflation. I think it's demand-driven inflation, and when you get a lot of increased demand, it puts and shows you the spotlight on your vulnerabilities in your supply chain. So we've increased the money supply by 31% since March of 2020, right? 31%. So there's a lot of demand being created, and we are reliant on our trading partners for most of our goods. So when you had a big increase in demand, it's showing us where those vulnerabilities are. And I just don't see that abating anytime soon. So I definitely agree with Nancy that you should always have some form of inflation protection, but I really think you need it now. So if you look back, I mean, I was even looking at what Joe Biden's looking at, $1.85 trillion in new spending for social agendas, for climate change, on top of the $1 trillion we're looking for infrastructure spending. So I constantly see more spending, more debt monetization. And now we've got these supply chain issues that have to be resolved. So I just don't see this being resolved quickly. So I think we're going to have an extended period of heightened inflation for some time.
Okay, so Bob, do you think that the Fed is agreeing with you guys that about how long the situation might last, or are we getting signals that they think it's transitory?
Well, I'm a believer in follow what they do and not necessarily what they say. We've been hearing the word transitory from Chairman Powell for months and months, and he may be right to a certain extent for a small part of the economy. But just the other day, I think David and I talked about this the other day. Chair Powell came out and said, you know what, some of the inflation that's coming into the system right now is going to be much more permanent and probably extending a little bit longer than his transitory definition. So I think that the Fed is worried and concerned about things. I think they're waiting to see, so to speak, the whites of their eyes of inflation before they start making any drastic moves. I'll tell you what, I would put my money on the Fed doing the right thing. 42 years now, they've been fighting inflation since 1979, 1980, and they've been doing a pretty good job. Of course, they haven't had a pandemic to deal with, but I would bet my money that the Fed is going to do what they need to do to make sure there's not inflation the size that we had back in the 1970s. So I think definitely the Fed is they're a little bit behind the curve, but I think they're going to get up to the curve pretty soon.
I would love to believe that the Fed's going to be able to jump in and aggressively stop this, but this is not the 1970s. This is not the Paul Volcker generation, right? So at that time, the debt to GDP ratio was 30%. Right now, it's closer to 100%. We live in a debt-fueled economy. It exists because interest rates are low. As soon as you start to increase interest rates, you're going to see stress cracks throughout. And that's going to force a recession. So I don't see their ability to dramatically increase rates. Paul Volcker took short-term rates up to nearly 20%. We know what that would do here. We're not suggesting that you've got to take them to 20% to control inflation, but any meaningful increase in rates is going to cause a stress and it's probably going to lead to a recession. So the Fed, I think, is stuck. And that puts us in a pretty vulnerable situation where I think that we've got to tolerate higher inflation for longer because the alternative is directly fighting inflation. And when you directly fight inflation through raising interest rates, that's going to make us vulnerable towards a recession. So I think we have to get comfortable with the idea that inflation may be higher for longer.
Okay, well, they are going to start tapering their stimulus. And Nancy, talk about coming rate hikes and these already being baked into the market.
Yeah, so globally, the front end of yield curves around the world are really pricing in a very, very hawkish central bank. So in the US markets, there are over 5 hikes, so 125 basis points, assuming 25 bips per hike, priced in before the end of 2023. So I personally think that's aggressive. Imagine the Fed hiking 5 times combined with the tapering, especially as we're heading into midterms in 2022. So I do think the rates market in the front end has gone super hawk. But at the same time, the back end of the curve, the duration, long dated government bonds have actually been bid. If you look at the end of Q1, the 10-year Treasury was around 175 basis points. We've had about 6 CPI prints since then. 5 of them have been with a 5 handle or higher, and 10-year yields are now lower. So it's a bit of a head scratcher because the front end of the curve is saying super hawk, and the back end of the curve is saying, hey, it's safe to come out of the water and buy bonds and own duration. So we have this real disconnect between the break-even market, which is CPI inflation, versus where the term premium of interest rates is saying we're heading in the future, which is lower and definitely in the transitory inflation camp.
Yes, I agree. The bond market is calling calling the Fed's call of inflation, calling it wrong. And when the bond market is obviously the largest trading market in the world, what they're calling that the Fed's call on transitory inflation and even higher inflation, it's not going to be any more permanent than maybe a year or so. So I agree with Nancy. I think that on the long end of the curve, it's telling a story, and the Fed has to pay attention and listen to that as well too.
Right. So anticipating what the Fed might do and possible new path upcoming for the Fed if they get a different chairman. How does this relate to what investors need to do? So David, talk a little bit about the current generation of investors and how they see inflation. Are they accustomed to it? Do they react differently these days, or do they need to wake up?
I think people are waking up. People see inflation everywhere. They see it everywhere and they're starting to react to it. They're starting to challenge this transitory argument because they see prices rising all around them. You could see that in a bunch of places. So consumer expectation surveys, you're seeing inflation rising. The fixed income market's starting to finally price in inflation. Real assets have been pricing in inflation for some time. Commodities prices react immediately to supply and demand. You're starting to see some gold prices respond a little bit. So you can see the market starting to digest that there is an inflation problem.
Okay, so Bob, tell us what do you think are the main sectors, the main beneficiaries of this kind of inflationary environment?
Well, the most obvious one is gold, in precious metals and silver. What happens in an inflationary environment, and David talked about this with the increase the balance sheet of the Fed and increase the monetary supply. What happens is when velocity starts coming in and you see a lot of turns in the currency and the dollars, that's really what creates a lot of the inflation. And when that starts to hit the markets in a big way, you're going to see more people trying to get away from the fiat currency. You're going to see dollars starting to slump. You're going to see other currencies starting to slump, and then the other replacement you see for that is mostly in hard currencies or something like the dollar or silver, platinum, hard commodities that are a little bit more reliable and safe than the fiat currency that we currently use today. But I think precious metals are a good place to go. There are inflation hedge type stocks that have good, strong yields, consumer durables and so forth. If names like a Coca-Cola or a Procter and Gamble, they're boring, they're old, and they don't offer very much, but they do offer safety and they offer yield and protection if you have to be in the equity market. So that's where I would go.
I definitely agree with David's point that the Fed is in a tight environment because so many hikes have been priced in. So I think positioning for less hikes, because 5 hikes before the end of 23 with tapering, I think will be too much for the real economy. So I like actually using the interest rate markets as a way to profit from lower front-dated yield expectations or higher long-dated yield expectations. I think that's really the key, is not having to take a bet on the level of interest rates, but really a bet on that spread widening, meaning front-dated yields being priced for 5 is too high, and then long-dated yields not having any fear of inflation is too low.
When you get higher inflation, commodity prices immediately respond to the supply and demand imbalances. We saw that already. Natural resource equities, these are the companies that benefit directly from higher commodity prices. They outperform. Both of that's already happened. Gold historically outperforms on the second half of the inflation cycles. People realize now, right? It takes a while to realize you have an inflation problem. We've had an inflation problem for a year, but now inflation expectations are starting to rise. Gold's starting to catch a bid. And if you look at the previous inflation cycles, gold responds in the second half because people wake up to the idea that they have an inflation problem. They've got to do something about it. There's also other investments as well that provide, I would say, less upside to inflation, but they are strong inflation hedges. You can think about infrastructure. These are companies that can quickly pass along inflation to their customers, and REITs have always done well. So real estate rises with inflation as well as rents do as well. So those are the core assets that typically benefit the most from inflation. And that's how we're positioned. All the assets that I just described, with the exception of gold, are the assets that are basically leading the markets higher since inflation's been a problem. So those are the assets that benefited the most during the 70s. Those are the assets that benefited during the inflation cycle that we had, the short cycle that we had in the early to mid 2000s. And those are the same assets that are responding right now. So I think history is very much playing itself out as it has in the past.
Okay, what is your take, Bob? What benefits most from this supply-demand mismatch?
So companies that have that sticky prices, right? Some companies that can raise prices and have them be able to pass through to customers and so forth. So one group that I think is going to benefit, certainly in the short term and the long term, are the rails. I think this group can raise prices because deliveries need to happen. Well, we've noticed that more recently, supply chain issues. We've seen a lot of ships that are sitting out in the seas, especially off of California, waiting to get unloaded and waiting to get taken to their destination. These rail companies can raise prices because these deliveries have to be made. Now, this is just a short-term problem right now, but eventually, those price increases that they make over time, like a Union Pacific is one, Consolidated Rail, CSX. Norfolk Southern, Kansas City, Southern, a couple other names in Canada. So these companies have a great advantage right now to raise prices and see those stick. So these imbalances that are occurring right now, probably a good opportunity for them. Also, I see banks and financials having the same sort of advantage. They can raise prices here as well too, with services and so forth, and with interest rates fluctuating as they have been right now, and I'm kind of in agreement with David that interest rates are going to be on the rise, certainly over the next 3 to 5 years. They're going to be able to raise prices and have those stick too. So number one would be those rails and transports, and number two would be the financials.
So how will this situation get now that when we get deeper into the holiday shopping season, and also looking at energy? You know, this is the heating season, and we've already seen oil prices, gas prices. Is this all going to be exacerbated?
It's a continuation of the same thing. So as long as we continue to print money, spend money we don't have, and the supply disruptions don't seem to be going away anytime soon, that leads you to the obvious conclusion that this is going to continue.
Talk a little bit about money supply, this spike in money supply you see as significant, David.
If you go back and look at the previous cycle, so go back and look at the 1970s, we had a massive increase in the money supply at the same time that we were very reliant on foreign imports of oil, which again increased the money supply, puts a big spotlight on where you're vulnerable. Then you had to increase a big surge in the price of oil relative to the US dollar. At the same time, we abandoned the gold standard, which allowed us to really blow out our money supply, which then led to inflation. Go back to the 1940s, you saw something similar to finance World War II. We came out, increased the money supply, lowered interest rates. We had another commodity boom that led to an inflationary spiral. 2008, we had a big increase in the money supply. There wasn't an increase in CPI, but there was asset price inflation because that's where the money went. So if you look at 2008, real estate went up, stocks went up, bonds went up. So it's where the money's going to. And now we've fast forward to 2020 and we've got a big increase in the money supply. We've got wealth redistribution. We've got a transition to clean energy. So you could see these structural changes that are leading to this, but it's really baked on this idea of the increase in the money supply, which is the end, which leads to the end result, which is a mismatch in supply and demand, where you get a surge in demand, and then it shows us our vulnerabilities in supply. And every time it's a little bit different, but the origination starts with the money supply. And that's why I want to keep harping on that, because a lot of times the narrative is always, well, there's just these supply disruptions. And once we resolve these, well, we're going to be fine. But we started talking about how quickly the supply disruptions were going to be resolved, a year ago, right? It was only going to be a few months, but that didn't happen. And now every article you read and every CEO you see speak is constantly talking about these disruptions. But the root of that is the massive increase in the demand.
Yeah, David, you probably remember some years ago when Ben Bernanke wrote a speech and talked about dropping helicopter money. Are you familiar with that? And so basically, that's just what happened this last year and a half. He said basically to increase the money supply, it was akin to dropping bags of money out of a helicopter, and that's simply what they did. And David's spot on with talking about the increase in money supply and how it affects supply and demand imbalances right now. Interesting that if we had a different situation with supply, if we didn't have this supply chain issues right now, you would probably have that supply meeting that demand. We would have an enormous rise in GDP. Yes, still a rise in inflation because of the larger dollars. But I think the issues and the problems would probably be less than they are today. I'm just hypothetically speaking here, of course. But I think things would be a lot better. But I tend to agree with David with that money supply. It's a real problem right now, and with the Fed and working that printing press, it's really hard for them to stop.
As we sort of move into how best to rebalance your portfolio, just want to get your take on different sectors that benefit. Where does cryptocurrency fall in all of this? Because that really doesn't have a huge historical precedent. David?
So crypto is challenging gold. Gold and crypto, when you start to think about them, there's a lot of the same attributes. So there's a finite supply. So that only 21 million crypto coins can be made, right? So you've got this finite supply, just like you do with gold. It's easily exchangeable to dollars, so another similarity, and it can't be counterfeited. So when you start to think about this, the new generation is looking at this as a gold alternative. And since cryptocurrencies have come out, clearly the total return is well exceeds that of gold and really everything else. And on a calendar year basis, cryptocurrencies have outperformed gold almost every year since they've launched, specifically talking about Bitcoin. So I think it's interesting. And I think it deserves a spot in the portfolio. It's very volatile, so you have to risk weight it. We do own it in our portfolios. We do own a lot more gold than we do crypto, but we think that it deserves a spot. Unlike gold and the other real assets, we can't go back and look at the 1970s and other high inflationary periods and say, I can tell you that it's a inflation hedge because I can show you historically that it did that. We can't do that, right? Because it's a new asset. But what we can do is we can look at the attributes and say it has a lot of similarities to assets that we know have historically performed well in high inflationary periods. That's what we're doing. That's why it made its way into the portfolio. And so far, it's been a great performer for us.
The thing that I'm very concerned about is actually if we have higher prices that come to whether it's labor costs or inputs or manufacturing, higher prices we're seeing. And the concern that I have is we'll have higher prices, but not the earnings per share growth that is priced into the market. So more of a stagflationary environment, which we did have in the 70s. And that was a result of the oil embargo. I don't think that's going to happen again today, but we are having a labor crisis with people not going back to work or people having shortages of labor. We're also having supply chain disruptions around the world. And we have a global chip crisis. And to me, it's history repeating itself with a different underlying problem, which is this chip, labor, and supply chain shortages, which I think could lead to higher prices, but lower growth. And that is really an investor's biggest nightmare for a traditional 60-40 portfolio, because in stagflationary environments, corporates, whether you own, Apple stock or Apple bonds, corporates have a hard time in that environment. And that's when stocks and bonds can sell off together.
I'm all about diversification. Diversify your portfolio, diversify your assets. You should have some gold, I think, some growth assets, real estate, bonds, and throw in some cryptocurrencies as well too, because it's a good diversifier. It's not real correlated with any other asset class at all that we've seen. It doesn't go up when gold is going down and vice versa, or the dollar as well. So, again, a good diversifier here, uncorrelated, is going to add some value to your portfolio. So I would agree.
All right. So, David, tell us what you think is the best way to get all of these different sectors, all of these different areas that respond well to inflation into your portfolio.
Yeah. So we manage the VanEck inflation allocation ETF, and it's basically that, right? We go and invest in the investments that we think are best positioned to benefit directly from inflation. So the ticker on its RAAX, RAAX, and what it does is it bets in commodities, natural resource equities, gold. It does have some Bitcoin exposure. It does own some REITs. It also has some infrastructure investments, and it has some yield plays. So it has MLPs, et cetera. So when you really just bottle that down, right, and you look at what we have, it's really the assets that have historically done best during high inflationary periods. And it's doing that just now, right? So if we look at how the fund has done over the last 12 months, right, CPI has obviously shot up and the fund's up, close to 50%, just shy. So it's definitely doing what we expected it to do during a high inflationary regime. And that's not a big shock, because if you look at those assets, that's exactly what's happened in the previous inflation spikes that we've seen in the 70s as well as the mid 2000s, when real assets have really distinguished themselves versus other assets that are disadvantaged from higher inflation.
Can you tell us a little bit about how you built it and sort of risk weighted this? Looking at historical inflation.
We're a big fan of risk weighting assets, so giving people a constant volatility profile over time. So what we do is we build a portfolio with a quantitative approach that dynamically weights the assets to give investors that stable risk and return profile. Right now, we're biased more towards commodities, natural resource equities, because right now, those are the assets that are best responding to inflation. We expect gold to start to perform from here, but it really hasn't. If it doesn't, we're going to continue to stay underweight. But if it does, we will gradually shift that allocation there over time. Our Bitcoin exposure is relatively small, especially relative to that of gold. But the beauty of investing in such a volatile asset class is that you can invest a very small piece of the portfolio and get a pretty large benefit. And that's what's happened with us so far.
I mean, listen, we can't predict what the future is going to be, but we can always just get ourselves set up for that whatever scenario comes out. And I think this is somewhat new for most investors these days. I don't know of a lot of investors today, especially my age, who were around investing back in the 1970s. So if we're looking at some sort of a situation or environment that mimics the 1970s, we're talking 40 plus years ago, 45 plus years ago, a couple of generations ago. A lot of these people aren't familiar with the struggles that were had back in the 70s. I was just a young kid back then, but I remember my parents would tell me, how difficult things are. Prices were expensive, gas lines and so forth, that sort of stuff. So, again, 45 plus years have passed since we've had to live through that sort of a situation. And I think that, you have to diversify yourself away and prepare for something like that to happen. Is it definitely going to happen? David's a lot more sure than I am, and I think a lot more sure than Nancy. But, if that happens, we have to be prepared, because, we're going to get clocked upside the head if inflation starts climbing up, double digits or something like that. It's going to be unsustainable, and the economy is going to take a real hit.
And if it does 10% or it eases down to 2% or whatever, David, what happens to your fund? Does it have a place in my portfolio either way?
It does. So if we go into this period where inflation is declining, we will shift towards the real assets that have a higher carry, right? Meaning the assets that you get paid to be in. So REITs, infrastructure, these are the assets that have historically done well, whether inflation's at 2% or 10%. So we will just shift the allocation around using our quantitative process that looks and says, well, what's working, and let me go towards that. One thing I'll also say as well is around sizing. We did a study, and we went back and we looked at all the high inflationary regimes and how much real assets you would have to own as a percentage of your portfolio from the 60-40 to actually give you that real return. Because we know as inflation picks up, it starts to erode the capital, right? It starts to destroy the real returns of the S&P 500 as well as that of bonds, specifically bonds. And we found that if you looked at those high inflationary periods, specifically the 70s as well as the early to mid 2000s, you would have really had to own a 10 to 15% allocation to real assets to give you a reasonable return on your investments. So that's how we think about it from a total portfolio holding standpoint, 10 to 15%. And if inflation does pick up as we expect and does maintain at this level as we expect, then we think we're going to do really well. If I'm wrong about that, which is fine, we've been wrong before, and inflation does settle down, well, then what we're going to do is we're going to start to pivot towards the assets that still benefit from inflation regardless, because inflation's a problem. And I think Nancy hit on this earlier, whether inflation's at 2% or 10%, inflation is still an issue for your portfolio, and you have to have protection against that.
Be ready for something tough to happen. It could be a very tough environment. I think the Fed has been in a box, and that box has been getting smaller and smaller as time goes on over here. We often see at the end of a good run of growth in the economy, the Fed starts cooling things down and oftentimes pushes the economy into a recession. I'm not sure if that's going to happen this time around. It may be something worse than that, with a spike in inflation that might be not be tolerable for a long period of time. David's been talking about this for the whole call here. But I think that if you're defensive and finding something in there with some value, some dividend, high yielding names, I think that's the way to go.
Okay, so let's just talk a little bit about the White House, a little bit more about this social agenda, this packages that could be coming down the pike, putting more money in people's hands. David, what impact do you think that will have? Will that drive up prices also?
Yes, I think it's more of the same. We saw something similar again during the 1960s with LBJ. There's a war on poverty. At the same time, we had the increase in the base of the money supply. I think I've spoken up about that. But now when we start to think about, well, what has to happen now to change the course of inflation? And I could tell you it's not printing more money and spending more money. So every time when you see a new agenda to spend money and get it into the hands of people that need it, that have a higher propensity to spend and save, that's a recipe for higher inflation. And that's what I continue to see out of the White House.
And infrastructure is a big part of your fund as well. What will happen with a large infrastructure package?
We would be a direct beneficiary as somebody that invests directly in infrastructure. So I do look forward to infrastructure investment, hard infrastructure investment, because that's a reasonable allocation within our portfolio. So we would be beneficiaries.
And Bobby, talk about the green transition. Anything you have there that you think was is worth noting?
Yeah, some of these electronic EV companies have been very, very popular, very strong. My focus really right now is on solar, and a couple of names that we've been playing around with are First Solar, which is a name that's been around for quite a while, SunPower, SPWR. These are just two companies, and actually, you know what, as a hybrid is Tesla. Tesla owns Solar City. So a couple of these companies are primed and ready for the investments that the government wants to make in green environment. So I think solar is a no-brainer. I think wind energy is also a no-brainer. But some of these fossil fuel companies, are still not making those investments there. That would say that, we're going to go away from fossil fuel and oil to move into a new direction. So I like wind, I like solar, hydrogen as well too. But the area that seems to be, excuse my pun here, hot right now is solar, and I think that's the area that is going to get the bulk share of investment dollars over the next 10 years.
So that energy transition, as well as automotive, David, would probably spike a handful of metals.
Exactly. So when you look at EVs versus traditional vehicles, it take around 5 times as much metals to make them, right? So you have this big transition, right, where we're underinvesting in traditional energy, and to get there, we've got to have more demand for metals. So we're in the middle of this major, massive transformation that's going to take an extended period of time to get there, and it's causing mismatches in supply and demand. So we think that these add to the inflationary fires, and they're only going to do so for an extended period of time.
What about demographics and your advice for different generations, like Gen Z versus, retirees, which you say could suffer even worse than in inflation than recession?
Yeah. So if you go across the spectrum of demographics here, from 19 to 29-year-olds all the way up to 85 to 95-year-olds, different priorities, obviously, and also retirement. Benefits. I think my kids are in their early 20s, and I've told them to be prepared for the fact that there's going to be no Social Security for you when you retire in 40, 45 years. And if there is Social Security, they probably won't be gaining benefits until they're 95. So it's on them to live as long as they possibly can, so they can reap some of the benefits of the money that they're going to get. So in all likelihood, there's not going to be enough money for them. So they really have to turn to themselves to take care of their future. It's always been there, but I think it's more critical now today for young people in their teens, 20s, 30s, 40s to be prepared for that. And for them to be prepared for that is to be a little bit more aggressive on the risk curve and take advantage of the opportunities that are there. And thankfully, there are more opportunities today than there were when I was, in my 19s or 20s. There's crypto, there's a lot of other mining companies that are available to them to invest in. I think what's difficult here is to try and raise enough money and earn enough money. The yield that they're going to have to earn is quite higher. It's a much bigger hurdle than it was for me when I was younger, even the generation of retirees right now. So it's a difficult task. I don't think it's impossible.
Yeah, I do think we have had the great resignation given the pandemic. And I do think many investors are not in the labor force. So they are actually more at risk to their portfolio in case there is inflation, because they're not going to benefit from the wage inflation side of their personal balance sheet. As you retire, you need to have more fixed income, more stability in the portfolio. And it's just a tough environment as a fixed income investor because everything has had a lot of financial inflation in markets. So looking for diversification is key, no matter where you find it. And I think that's really key, to look at many different things to give you a diversified portfolio, whether it's inflation, deflation, stagflation. Nobody really should be taking a bet because this is unknown territory where we are.
Right, and the younger folks in labor force are benefiting from wage inflation right now. Bob, I just want to jumping around, but I want to give you a chance to comment because you make a big distinction between wage inflation, commodities price inflation.
Yeah, so wage inflation is something that it's the big bugaboo in the room that hasn't really been talked much about. We did hear Chairman Powell talk a couple of weeks ago on Capitol Hill that he didn't think that wage inflation was enough to trigger a big move in the Phillips curve, which is an economic model that has a relationship between wage increases and inflation. It's been pretty much flat for almost a couple of decades now. I think it's ready to rise up again. I think wage inflation is going to be something that's going to be a hindrance to earnings. We heard it last night with Starbucks and Amazon. Both earnings came out, and they did say wage pressures were putting a major crimp on their margins. So are they able to raise prices enough to offset some of those wage increases, or are they going to make their shareholders suffer by having lower earnings? And I think last night we saw the first shot across the bow with these bigger wage increases. That the answer was, it's going to hit their margins, and they can't make all these price increases stick. So, Amazon, of course, obviously been one of the best in terms of pricing for consumers. We'll see how that goes over the holidays.
Right. So we're hearing a lot more about inflation working its way into companies' bottom lines. What do you worry about, Nancy, as far as corporate earnings?
That's exactly the concern, that we might have a stagflationary environment. If companies are experiencing higher wage costs, higher input costs, and they can't pass along that price increase to the consumer, that's where you have a stagflationary environment. So I know that would be a really terrible outcome for most, for traditional 60-40, because in stagflation, which last happened in the 70s, that's when stocks and bonds can actually sell off together. So hopefully that won't happen. But I think it's one of these, we have a very crazy environment right now where we have a taper likely coming later this month. We have 5 hikes being priced into the front end of the curve. Interest rate volatility is very, very low. And I'm not really sure why, because we have fiscal spending for the first time and actually real inflation. You can see it in the numbers. You can feel it in your everyday life. So I think the market is telling you, the interest rate markets are saying, everyone thinks this is going to be transitory. People are not concerned. And that's exactly when you should be looking at buying things. When you have complacency and groupthink and everyone thinking things are going to be fine, that's exactly the time that you should be adding diversifying assets, especially ones that are not trading near their all-time highs.
I have to agree with Nancy on this, that I'm a bit concerned about the stagflationary scenario. That's something I keep looking at and I keep coming back to, and it concerns me. Right? Corporate earnings are under pressure. Listen to all the earnings calls, listen to CNBC, CEO, CFO after CFO coming on talking about how their margins are being pressured by wage inflation. It's an issue. There's been a big change in power between employers and employees. Employees are now taking the reins and taking control in the sense of being able to demand higher wages. And as we continue to see that, there's going to be implications of that. I think profit margins are going to go down. Eventually, they're going to have to pass them through in the form of inflation. So I think that they do, but margins are going to take a hit as well. And it's this constant cycle. And that's why you want to start shifting away from S&P-like companies towards companies that actually benefit from higher inflation, because you're in this constant race. Prices rise, you're trying to pass them through. Prices rise, you're trying to pass them through. And as this continues to happen, right, you're getting margin pressure. So pivoting towards assets that actually benefit from higher inflation, that's where you can actually distinguish yourself. And that's what we're trying to do.
Okay, so as we start to bring the conversation to a close, I just want to ask each of you, sort of your biggest takeaway. I'll start with Bob. What would you say investors really need to glean from this conversation?
Well, they have to be aware of change. Change is in the winds right now. And one of the things that for equity investors, they have to pay attention to is what's happening with the Fed. And the Fed is going to pivot to a much tighter hawkish policy not just by words, which they've been doing for the past 3 or 4 months, but by actions. And we think that starting next week or so, with the next Fed meeting, they're going to announce plans to start tapering very, very soon. They have been leading up to it for the past couple of meetings, and I think we'll get a little bit more permanency of when they plan to start doing this and how long it's going to last, 6 to 8 months, I think, to about the middle of 2022. And then we're going to get a little bit of a view in December at projections about inflation and Fed funds, about where they think rates are going to be out in 2023. So I think the change has to be considered here. Investors have to pay attention to what's going on and start shifting their money into different areas for investors to take advantage of this change.
Great. And Nancy, what would you say people should remember from this hour?
I hope this is helpful for people just to have a discussion about some of the risks. I think at the end of the day, it's a very challenging time for investors because there has been so much financial inflation, and there are not a lot of good assets and good things to buy that are cheaply priced. So I hope this was informative to the audience. I hope it was thought-provoking and helpful, because at the end of the day, it's a tough time to be an investor, especially not knowing whether inflation is going to stick around or not.
Yeah, it sure is. And this has helped so much. David, any closing thoughts?
I think that there's 3 key takeaways. The first is that inflation's here. It's undeniably a problem, and it's unlikely to go away anytime soon. The second takeaway is that there's good news and you can actually do something about it. Go out and buy real assets. Real assets have historically performed the best during high inflationary periods of the past, 1970s, mid-2000s, and are currently leading the market higher now. And the third takeaway is consider the VanEck Inflation Allocation ETF. The ticker is RAAX. It gives you exposure to those key inflation-fighting assets. It does it in a risk-managed way. And it also has the ability to dynamically adjust the different inflation regimes to help you pivot and manage inflation going forward.
Well, great advice. And with that, I want to thank all of our guests: David Schassler, Portfolio Manager of the Inflation Allocation ETF RAAX at VanEck; Nancy Davis, Founder and CIO at Quadratic Capital Management; and Bob Lang, Action Alerts Plus Portfolio Co-Manager. You've been watching How to Play the Inflation Trade, brought to you by our partners at VanEck. I'm Susan McGinnis.